everyone. Just want to give everybody a few more seconds to settle in, and we're excited to get started tonight. Thank you so much for joining us. All right. Well, hello and welcome to this evening's webinar, AAII and Better Investing Smarter Sentiment Strategies. I want to say, thank you so much for joining us, and we are happy to have you all here. My name is Jennifer Shear, and I'll be your host for tonight. And a few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And we have two wonderful speakers tonight, Wayne Thorp, who is our head of research and analysis at AAII, and Doug Gerlach, who is the president of ICLUBcentral, a subsidiary of Better Investing. And I want to thank them both for being with us here this evening. And be sure to keep an eye on your chat throughout the webinar. We'll be sharing some helpful resources, some links, key insights throughout the event. And then if you have any questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, I'll select a few for Wayne and Doug to answer. And then if your question isn't selected during the broadcast, you can feel free to email us at members@aai.com. And then if you experience any issues with the audio or video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. I'll also put a helpful link in the chat section later on. And then just a friendly reminder that the presentation is recorded and a replay of the webinar will be sent to all who attended today. And then the recording will also be available at aai.com/webinars and then also on the Better Investing website. And in this presentation, Wayne and Doug will cover a few things such as how to interpret and apply sentiment data using AAII's long-running surveys, stock screens, and our newest sentiment investing dashboard. And then how to track investor interest and behavior with Better Investing's most active list, ticker heat maps, member sentiment tools, and more. And then we'll go over some actionable ways to integrate sentiment data into your current strategy. And then, of course, we love our webinars being interactive. So after our presentation, we'll host a live Q&A, including two special promos from AAII and Better Investing. So please make sure to stay for the entire broadcast. And with that, I'd like to hand over the presentation to Wayne to kick us off.
Thank you, Jenna. Good evening, everyone. I'm Wayne Thorp, Head of Research and Analysis at AAII. Tonight, I'll share with you one of the most powerful yet misunderstood tools in investing, investor sentiment. But more importantly, I want to show you how the game has fundamentally changed and why the old rules may not apply. For the next 20 minutes or so, we'll explore how measuring the collective mood of investors can provide crucial market insights. We'll examine AAII's nearly 40-year history of tracking investor sentiment, look at what extreme readings have meant historically, and most critically, discuss why sentiment patterns since 2020 suggest we may be in an entirely new market regime. Whether you're a seasoned investor or just starting out, understanding sentiment will help you avoid the herd mentality that destroys wealth and recognize opportunities when others are paralyzed by fear or blinded by greed. So here's the roadmap for my segment tonight. We'll start with the fundamentals, what investor sentiment actually measures and why it works as a contrarian indicator. Then I'll introduce you to AAII's Investor Sentiment Survey, the longest running measure of individual investor psychology. We'll examine historical sentiment extremes and the relationship to market performance. Some of these examples will be familiar to you, others may surprise you. I'll also showcase our new sentiment investing platform and demonstrate how our most followed stock screens reflect changing investor preferences. Now, I have a lot of material to go through, arguably could last probably half a day, so I'm going to move rather quickly. We are going to take questions at the end, but you can also reach me at Wayne, W-A-Y-N-E, at AAII.com with any follow-up thoughts or questions. So let's start with the basics. Sentiment describes a collective of emotions, opinions, and attitudes of investors at a specific point in time. Think of it as the market's mood ring. It doesn't predict the future, but it reveals the present state of investor psychology. So why should we care? Well, because in the short run, emotions drive prices just as much as fundamentals, if not more. We've all seen it, stocks soaring on hope or crashing on fear, often disconnected from actual business performance. But here's the key insight. If we could forecast sentiment changes, we'd have a tremendous advantage. But that's the catch. Sentiment shifts are only visible in hindsight. By the time we measure extreme optimism or pessimism, the market has already moved. So this begs the question, why track it at all? Because extremes in sentiment often coincide with major market turning points. Not because sentiment drives these returns, but because it reflects the exhaustion of buying or selling pressure. The real value of sentiment data is in prompting reflection. When everyone agrees, it's time to think independently about what could go right or wrong. So this brings us to a crucial distinction. Market sentiment is the sum of all market expectations filtered through experience and emotions. It's backward looking by nature. That means it tells us where we've been, not where we're going. There's no causal relationship between sentiment and market direction. When investors are pessimistic, it's because the market has already fallen. And when they're euphoric, it's because they've already experienced gains. This might seem to make sentiment useless, but it's actually what makes it valuable. When sentiment reaches extremes, it often signals that the fuel driving the current trend is exhausted. The operative word is often. Sentiment isn't a precise timing tool, but a condition that suggests heightened probability of a reversal. And here's where sentiment becomes actionable. History consistently shows that markets tend to move against the majority. This isn't because markets are perverse, it's a simple matter of mathematics and psychology. When bullish sentiment reaches extremes, it typically comes after strong market advances. Investors are fully invested, they're borrowing to invest more, and they're convincing others to buy. However, here's the problem. If everyone who wants to buy already has done so, who's left to push prices higher? As new money dries up, the market stalls. Without fresh waves of buyers, any negative news can trigger a selling spree. And because everyone's fully invested, they have no dry powder to buy the dip. So the market rolls over not because sentiment was wrong, but because it was too right. Everyone acted on it already. The flip side is even more powerful. When bearish sentiment reaches extremes, investors have already sold. They've moved into cash, are hiding in bonds, or hoarding gold. The selling pressure that drove markets lower has exhausted itself. So here's the beautiful part. Unlike bulls who've run out of money, bears sitting in cash have tremendous potential buying power. They don't need new money. They need a reason to deploy what they already have. Eventually, valuations become too attractive to ignore. A few brave souls start buying, prices stabilize, and others notice and join in. Before long, all that sideline cash comes flooding back and markets rebound strongly. The pessimists had the right instinct to protect capital, but they mistimed their entry. This is a classic behavioral error that the data indicates we can exploit. So now let me introduce you to the AAII Investor Sentiment Survey. We've been asking the same simple question every week since July 1987. What direction do you feel the stock market will be in 6 months? Bullish, bearish, or neutral? Otherwise, up, down, or sideways? That's it. No complex methodology, no adjustments, just raw investor opinion. The 6-month time frame is crucial. It's long enough to filter out the daily noise, but sufficient enough to reflect actionable views. Only AAII members can participate, and it's 1 vote per person per week. The simplicity encourages participation and captures gut reactions rather than overthought analysis. We compile these results every Thursday and publish them on our website as well as in Barron's. Our members aren't professionals trying to sound smart. They're real people sharing honest opinions. That authenticity has made our data particularly valuable for identifying market extremes over nearly 4 decades. Now let's look at the historical boundaries of investor sentiment. Over nearly 2,000 weekly observations, bullish sentiment has averaged 37.6%. This slight bullish bias reflects the market's long-term upward trajectory. The extremes are instructive. Peak bullishness of 75% occurred in January 2000, just months before the dot-com crash. However, equally telling was November 1990, when only 12% of members were bullish, the lowest reading ever. The Gulf War loomed, recession gripped the economy, and the S&L crisis undermined confidence. Yet this extreme pessimism marked an excellent entry point, with markets gaining 21% over the next year. Bearish sentiment peaked at 70.3% in March 2009, within days of the generational market bottom of the Great Financial Crisis. Its low of 6.8% in August 1987 preceded Black Monday by just 2 months. 2 months later, we got our answer and the market crashed 22% in a single day. These aren't just statistics, they're lessons in mass psychology. When 3/4 of investors are bullish or bearish, the market is primed for reversal. So now I want to take some time examining our sentiment extremes in detail, beginning with January 6, 2000, peak dot-com mania. 3/4 of AAII members were bullish. Everyone was getting rich, or so it seemed. Tax drivers gave stock tips and grandmothers day traded. The S&P 500 closed that week at 1441. 1 year later, down 5%. 2 years later, down 20%. 3 years later, down 40%. The extreme sentiment didn't predict the exact top. That came 2 months later, but it clearly signaled dangerous overconfidence. What's fascinating to me is how long bullishness persisted. Even as the market topped and rolled over, investors remained optimistic for months. They'd been conditioned by years of buying the dip. This time, however, was different, and sentiment told you so. Now the opposite extreme, March 5th, 2009, the darkest days of the global financial crisis. Major banks teetered on collapse, unemployment soared, and the S&P 500 had fallen nearly 60% from its peak. At that time, nearly 7 out of 10 AAII members were bearish. The despair was palpable. The financial system seemed broken beyond repair, yet within days, the market bottomed at 666. 1 year later, the S&P had surged nearly 65%. Those who acted on extreme pessimism or simply held on were richly rewarded. The thing is, though, at the time, it didn't feel like a bottom. It felt like the world was ending. And that's what makes contrarian investing so difficult psychologically. Let's dig a little deeper into the statistics of extreme sentiment. Bullish readings, three or more standard deviations above average, are extraordinarily rare. In fact, there have only been 5 occurrences in 1,979 observations. That's 0.25% of the time. When everyone's that optimistic, it's noteworthy. What's the average 1 year return following such extremes? Just 0.6%. Compare that to the market's long-term 12-month rolling average of about 10%. Extreme optimism has consistently preceded subpar returns. More interesting is what happens at the other extreme. When bullishness falls 2 standard deviations below the average, which is essentially extreme pessimism by another name, subsequent returns average 18.1%. The message is clear. History shows that fear creates more opportunity than greed creates risk. But remember the rarity. These aren't signals you can trade monthly or even yearly. They're generational opportunities and warnings that require patience to exploit. Extreme bearish sentiment tells an even more dramatic story. Readings 3 standard deviations above average, and remember, high bearishness is bad sentiment, produced average 1 year returns of 24.5%. That's nearly 2.5 times the normal market returns. The last occurrence was September 2022, during the inflation scare. The market has since rallied strongly, validating the contrarian signal once again. What's remarkable is the consistency. Almost every extreme bearish reading has preceded strong returns. The opposite extreme, very low bearishness, which can also signal complacency, shows average 1 year returns of -7%. But these signals are also equally rare, occurring just 12 times since 1987. The bottom line, when no one's worried, worry. The asymmetry is crucial for investors. Extreme fear reliably signals opportunity. Extreme complacency sometimes signals danger. So when in doubt, bet on fear exhausting itself rather than euphoria persisting. Now I want to address something truly fascinating that I came across as I was putting together this presentation. We haven't seen bullish sentiment amongst our members exceed 55% in over 4 years. Let's put that in perspective. Over the 1900-week history of the AAII Investor Sentiment Survey, we're in the longest streak without euphoric readings in the survey's history. Is this a statistical anomaly, or does it represent a fundamental shift in investor psychology? Reflect on what we've experienced in the last 20 years. You have the 2008 financial crisis that shattered trust in our financial system, followed by the longest bull market in history, which has been called the most hated bull market in history. Then we had COVID-19, which fused health and financial anxieties in unprecedented ways. The traditional contrarian playbook says we should see euphoria at market tops. But what if investors have been so scarred by repeated crises that they've lost the capacity for true euphoria? What if 50 to 55% bullishness is now the extreme? Let's look at the data. 77 of 99 extreme sentiment readings, more than 3/4, occurred between 2000 and 2009. That decade, marked by the dot-com crash and global financial crisis, that may have been the anomaly, not today. We may have created a generation of permanently skeptical investors. Now, some may argue that the extreme market concentration of the latest bull market has muted euphoric sentiment. At their peak, the top 10 stocks in the S&P 500 commanded nearly 40% of the index's market capitalization. However, similar market concentration took place during the dot-com era when bullish sentiment hit its all-time high. This seems to confirm that investor sentiment is going through some type of fundamental shift. The potential implications are profound. For investors, this new dynamic suggests that waiting for traditional sentiment extremes to signal market tops may mean waiting forever. Instead, focus should shift to breadth deterioration, valuation extremes, and signs of fundamental weakness in market leaders. Let's be clear, this doesn't mean that risk has disappeared. Instead, it may suggest that risk may manifest differently than our traditional indicators suggest. The market may have lost its ability to feel euphoria, but it hasn't lost its ability to correct. It will do so just from a state of worry rather than optimism, making the next bear market potentially more psychologically devastating, as it will confirm the fears investors never abandoned. But there's another crucial dynamic at play. This chart reveals something disturbing about modern investor psychology: the vanishing middle ground in the investor sentiment. Since 2020, we've seen extreme pessimism more than double. Bullish readings below 25% have jumped from 9% to 21% of all observations. Meanwhile, that reasonable 35 to 40%, what I call the rational middle, has collapsed by 35%. Investors are increasingly either very bullish or very bearish, with little in between. In my opinion, this isn't just about markets. It reflects our broader polarized society. The same forces driving political and social polarization are affecting how we view investments. Social media echo chambers, algorithmic news feeds, and tribal thinking have invaded market psychology. The market implications worry me. With fewer moderate voices, sentiment shifts could become more violent. Where there's no middle ground, the swings between fear and greed become extreme. We saw this with the meme stocks, where coordinated moves forced institutional capitulation. And here's my concern. Passive investing now controls 57% of equity assets. Algorithmic trading represents 60 to 75% of volume. When you combine structural momentum with polarized sentiment, you get a recipe for extreme moves that traditional risk models can't predict. This binary thinking, you're either diamond hands or paper hands, bull or bear, risk on or risk off, eliminates the nuance that healthy markets require. The question isn't whether this will cause problems. Instead, when and how severe they'll be. These two phenomena, the skepticism ceiling and sentiment polarization, are interconnected. The inability to feel euphoric doesn't mean investors have found equilibrium. Instead, they're oscillating between moderate optimism and extreme pessimism with no stable middle ground. This creates a paradox for contrarian investors. The traditional sentiment extremes that signal turning points may no longer be applicable. When 50% bullish represents peak optimism and the middle ground has vanished, we need new frameworks for understanding market psychology. Let me share what I think is happening here. We have three converging forces. First, psychological scarring for repeated crises has created something akin to financial PTSD. Investors literally cannot achieve the dopamine response that created past euphoria. Second, structural market changes. Passive flows, algorithmic trading, options feedback loops amplify moves without requiring sentiment extremes. The machines don't need to feel euphoric to push markets higher. Third, information overload and social media have rewired how we process market data. Doom scrolling creates neurological changes that perpetuate negativity. We're chemically addicted to bad news. The investment implications are clear. We cannot wait for traditional sentiment extremes to time markets. Instead, we must recognize that in this new regime, moderate readings may represent extremes, and the absence of a signal may itself be the signal. This doesn't invalidate contrarian principles. However, it does require adapting them. When everyone is permanently worried, the contrarian position may be measured optimism. When bullish sentiment can exceed 55%, readings above 50% may warrant caution. Most importantly, with polarized sentiment and hair trigger markets, risk management becomes paramount. The next crisis may not announce itself with euphoric readings. Instead, it may emerge from the collision of moderately positive sentiment with severely negative catalysts, amplified by structural market mechanics that turn stumbles into stampedes. So based on everything I've discussed tonight, I led the creation of AAII Sentiment Investing, a comprehensive platform that goes beyond simple survey results. We combine our proprietary sentiment data with 9 other indicators to create a mosaic of market psychology. We track short interest for crowded trades, yield curves for recession signals, advanced decline ratios for market breadth, and the VIX for option implied volatility. We also monitor market momentum through the S&P 500's 50 and 200-day moving averages, as well as valuation using Shiller's CAPE. Each indicator is analyzed using decades of data to identify statistically significant extremes while avoiding data mining. We don't just show you the numbers. We explain what they've historically meant and what probability suggests about future returns. This multi-factor approach addresses the limitations of a single indicator. When multiple measures align at extremes, the signals become much more powerful. Here's our sentiment investing dashboard in action. The contrarian sentiment indicator anchors the analysis. This proprietary model identifies when sentiment reaches statistically significant extremes. Notice how both current readings and historical context are provided. A reading might seem extreme today, but be normal by historical standards. We also track the rate of change in investor sentiment. Sentiment moving quickly from neutral to extremes often carries more weight than sentiment sitting at moderately high levels. For each indicator on the dashboard, we have a Christmas tree color readout showing dark green, light green, white, orange, and red. The colors correspond to the indicator's historical read on future market direction. I also post periodic analyses on the individual indicators to provide insights into their current state in historical context. Then, each Thursday, I write the sentiment insights, synthesizing all these indicators into an overall reading on the stock market. Now, to assist with that, I've been testing a super indicator that combines these varied measures into a single probability-weighted signal. So far, my testing shows promising results, but this is still a work in progress. The goal of sentiment investing isn't to time the market perfectly. It's intended to identify when probabilities shift in your favor. When multiple indicators flash extremes, it may be time to act contrary to the crowd. If you want to learn more about AAII sentiment investing, we're planning a free online open house in early August, so stay tuned. Beyond weekly investor sentiment, each month AAII members can also vote their actual portfolio allocations. This demonstrates what investors actually do with their money, not just what they claim. Over the survey's history, the average AAII member holds about 62% in cash, 62% in stocks, 16% in bonds, and 22% in cash. These allocations fluctuate in response to market conditions and sentiment. The historical data trend shows that when stock allocations drop below 55% or rise above 70%, pay attention. The survey's data goes back to November 1987, capturing allocation shifts through multiple market cycles and black swan events. We've seen stock allocations as low as 41% in March 2009 and as high as 77% during the dot-com bubble. Both extremes marked major market turning points. What's fascinating is how slowly allocations change. Even as sentiment swings wildly, most investors make gradual portfolio adjustments. This inertia creates an opportunity for those willing to act decisively at extremes. In the coming weeks, I plan to integrate our asset allocation data into the sentiment investing dashboard based on my analysis of its contrarian properties. Now, this statistical analysis of asset allocation and market data reveals an uncomfortable truth. Individual investors consistently buy high and sell low. Stock allocations show a positive 49% correlation with market performance. This means investors add to stocks after they've risen and reduce after they've fallen. The pattern is depressingly consistent. After market drops exceeding 5%, investors reduce stock allocations by 0.33% the following month. But after rallies above 5%, they increase by slightly over 1%. They're literally doing the opposite of buy low, sell high. Furthermore, fear periods last twice as long as greed periods, averaging 11 months versus 5. This asymmetry compounds the damage. Investors often stay defensive for too long during recoveries, while jumping in too late during advances. The evidence isn't encouraging. At every market bottom, such as 2009 and March 2020, individual investors held minimum stock allocations. They panic sold precisely when they should have been buying. This behavioral pattern is so reliable that it's become a contrarian indicator itself, which is one of the reasons we're adding it to our sentiment investing platform. Lastly, I want to present another window into investor sentiment, the stock selection strategies which attract investor attention. Our Stock Ideas platform tracks 50 quantitative stock screens based on proven methodologies. The ones investors favor reveal their current biases. O'Shaughnessy's Tiny Titans and Small Cap Growth and Value screens top the list. They're micro and small cap value screens that also use momentum. Now, their popularity is probably driven to some extent by the two strategies' performance. Both rank among the top 5 since inception performance, spanning over 25 years. Past performance doesn't predict future results, but it certainly impacts investor interest. This data also offers a window into the investment styles preferred by investors. While AAII tends to lean into value-oriented approaches, the results in this table indicate that members tend to favor growth and momentum strategies when it comes to stock selection. However, like all good investors, our members do follow a range of strategies. And as you can see, there's a strong following of value strategies such as Buffettology and Graham as well. So now let me leave you with the most important takeaway from my segment tonight. Sentiment data reveals when emotions are driving markets, but it's your plan that prevents those same emotions from driving your decisions. We've seen how investor sentiment, especially at extremes, offers valuable insights into potential market turning points. We've proven that investors consistently buy high and sell low, destroying wealth through emotional reactions. But here's the critical insight. Knowing about these behavioral biases isn't enough. Without a concrete plan, you'll fall into the same traps. Think about March 2009. Bear sentiment hit 70%, the market had crashed 57%, and the world felt like it was ending. Those with a plan acted mechanically. In many cases, that meant standing pat while the rest of the world was panic selling. They didn't need courage, they needed compliance with their own predetermined rules. Those without a plan were likely making decisions based on emotion, specifically fear, waiting for things to feel better. By then, the opportunity had passed. They sold low and missed the explosive rebound. Your plan should outline when and when not to act. The specifics matter less than having them written down before emotions cloud your judgment. Remember, sentiment data is a tool, not a crystal ball. It works best when combined with other indicators, such as valuation, technical, and fundamental analysis. But most importantly, it works when you have a plan that transforms emotional markets into mechanical opportunities. In today's new regime of perpetual skepticism and polarized sentiment, having a plan isn't just helpful, it's more essential than ever. So write it down, test it historically, and then follow it religiously. Being contrarian isn't about courage, it's about process. When everyone else is losing their heads to fear or greed, your plan keeps you grounded. That's how you avoid herd mentality and build wealth while others destroy it through emotional decisions. So that concludes my segment of tonight's webinar, and we're going to bring in Doug from Better Investing. So thank you very much.
Hi, Doug. I think you might be muted.
There we go. Thank you, Jenna. Thank you, Wayne. We're going to take a look now at some of the tools that Better Investing offers that utilize the strength of the community in slightly different ways, perhaps moving from the strategic to the tactical. As a reminder, this is an educational presentation. I will be mentioning some specific companies, but this is only for educational purposes, and we expect that you'll do your own research, conduct your own due diligence about before you make any investment decision. Now, some of you who are familiar with Better Investing know that we love stocks. As founders of the original investment clubs, the organization supporting those, as well as individual members for now nearly 75 years, we've been helping our members to make better decisions about investing in the stock market. And we have increasingly added tools that bring together the knowledge of the community in much the same way that an investment club can be successful by distributing the work and having everybody contribute a little bit to the research of the portfolio. Now we are employing tools that allow all of our members to contribute to a common sense about a particular company or providing insights as a result of their own research. And so those consensus figures, those consensus tools now are a way for members to gain specific knowledge that can aid them in making decisions, as well as providing double checks of users' own judgment about a particular company. Now we're going to talk first about some of the tools that we have available that generate ideas, that provide potential investment candidates for members and for investment clubs. One of these is the most active stocks list, which is available to members in the magazine each month, as well as on the Better Investing website. And what's great about this is that the data is real data based on the investment club members, so we know what they're buying and selling. It's not self-reported, so there is a little bit more sense of accuracy about the stocks that are being bought and sold in the last 8 weeks. You can see the top 8 here, the number of buys and the number of sells. And of course, you can imagine that often the most active stocks that are being bought and sold by members are the mega caps, the large caps, the very popular companies. But we can continue to drill down. We have one feature in the magazine, the bubbling under list, which is a spotlight on one of the stocks that are making a bigger move on the list. It's published in the magazine with perhaps a little bit of context around it, and it gives you a sense of why our members might be looking at this particular company. This month it's United Health Group, which obviously has off its peak high prices for a number of reasons: cyber attack, pressure from regulation and the potential of increased regulation, the murder of an executive, failure to meet their guidance, all sorts of potential problems. And as Wayne pointed out, as a contrarian indicator, sometimes that can be a powerful mover. So we've got sellers outpacing buyers, right? Or buyers are outpacing sellers for United Health Group recently. So once again, an idea for you to consider. One of the big things that the organization's been doing for many years is an annual tabulation of the Better Investing Top 100. These are the top 100 companies held by our members. It's published every year in April as of the close of the prior year. We also produce the top 200 companies number 101 to 200 on that list. And so this is, as you might imagine, a mega cap and large cap weighted listing of companies, but it is also the basis for the Better Investing 100 index, which is tracked externally on a daily basis. It's rebalanced annually, and you can see the performance of that. We call it BIX, and there is a total return version as well. If you're interested in the top 100, we have a screening tool called My Stock Prospector that actually has the top 100 as a predefined criteria. So that allows you to drill down and sort the companies by total revenue or by earnings per share, historical growth, or any number of other factors. And that is also an interesting way of looking at the holdings of our members. Here is just the top 20 or 30 or so of the top 100 in the current year. So you can see a lot of familiar names. No surprise, Apple is at the top of the list, followed by Amazon, Nvidia, Alphabet, and Microsoft. But as you scroll down, you might be surprised at some of the companies. Some of them are more contrarian, perhaps, and some more defensive now. But again, remember that these are holdings of clubs, some of which are 40, 50 years old. So they have established portfolios where they're not necessarily going to unload these mega caps. They're in it for the long term, and they're going to sit and hold throughout whatever the market has to throw at them. Here's a graph of the Better Investing 100 Total Return Index for the last year. And so you can see that it reflects the broader moves of the S&P 500. Over time, it tends to perform close to the S&P 500 equal weight index. The BIX index is an equal weight index in that each company is 1% of the index as of the time of the reconstitution at the beginning of every year. But you can find this on the Selective.com website and track it over time, look at it in various incarnations and performance periods, and the index composition is also available. Now, we have a variety of educational presentations that we offer that provide member and volunteer supported ideas for further research. We present a monthly online chat webinar series called Ticker Talk, where we're talking about stocks. And each of those presentations, we have allow the panelists to offer 5 stock ideas in 5 minutes. So make your case, tell your pick, give the ticker symbol, tell why you like it, and then we're on to the next one. And those picks are archived on the Better Investing website. We have an area called Stock Ideas. And so these are, again, as you look at this list, you'll see not a lot of familiar names, not a lot of the large cap, mega cap, Magnificent Seven style. You'll see more mid-sized and smaller companies because the members and volunteers are kind of digging down into the market, looking for opportunities beyond the large cap stocks and what might be the next big winners. So there are some very interesting companies here. Some of these are being tracked by some of our newsletters like the Investor Advisory Service and the Small Cap Informer, but these give you a sense of what community members are considering. And what's interesting about all of these community-driven stock ideas is that often you'll get the same people coming up with the same brilliant ideas. The same stock will be in the newsletter, and it's gotten picked up by others who haven't seen the newsletter, but they're doing the screening using the same criteria. This is the value of having a common approach where you can contribute to the community with your research, and it will be highly valued by other members. Along those same lines, we have a feature called First Cut Stock Reports. These are multi-page research reports that are created by Better Investing volunteers and members. There's a template provided so that each of the contributors can detail why they made the decisions they made about selected growth rates and PE ratios and other judgment items, as well as that completed stock selection guide. If you remember from last month, I reviewed the stock selection guide and our online tool. This is a company analysis system that helps you understand the fundamentals of a particular company, evaluate the growth, the quality, and the valuation. So a completed stock selection guide is included with each of these first cuts. So again, this is useful both in finding potential investment ideas, learning how to go about conducting completing a stock selection guide, comparing your completed stock selection guide to that of someone who may be a little more experienced. Here is a roster of some of the recent submissions that have come in from volunteers and members. So again, you'll see here, Costco is certainly part of the top 100, but some of the other companies a little less well-known perhaps, and that gives you a sense of how to find opportunities in the market when we look at the perhaps high valuation of the S&P 500 right now. Investors who are looking at smaller mid-sized stocks are often able to find opportunities at not excessive PE ratios. So the first cut reports, as I mentioned, 5 or 6 pages. They follow a consistent template. They are edited for clarity and perhaps for content, and then that completed stock selection guide. And you can see the graph there for, this is for Costco, where sales, the green line, pre-tax profit, the magenta line, and earnings per share, the blue line, as well as the annual high and low prices as represented by the price bars, all moving up, all pretty consistent. Why this is a valued company that perhaps gains a little bit of premium in the market because of that consistency and level of quality. Now, another feature that we have is the ticker heat map, which details the most popular 100 companies studied in the last 90 days by members using our SSG Plus online stock selection tool. So as heat maps work, the size of the boxes represent the number of times the study's been created relative to all other companies in the last 90 days, and the color of the box indicates the relative favorability. Green for more positive, red for more negative. They're not buy-sell signals, but it's just an indicator of how the community is viewing a company at the current time, found in the SSG tools. So here is an example of it. It's broken out by sector, so technology stocks, healthcare, industrials, financial services, consumer cyclical, consumer defensive, communication, basic energy, and utility. The energy and utility stocks don't fit our model very well, so we don't see them being analyzed in the tool quite as frequently as some other companies. So down in the bottom corner, you'll see just a couple of those ideas. So as I described, the size of the box indicates how many people are looking at that company. So in the top left, NVIDIA is getting a lot of attention these days. And so over the last 90 days, so that's up there. It's not as dark green as some of the other companies, which indicates that the consensus is not nearly as favorable. Apple is not very favorable at all in that reddish color in this case. If we click on a company up here in the healthcare sector, Addus Healthcare, it'll pop up a little descriptor that will give you more about that particular company. So 582 studies have been created for this company. The historical sales of this company over the last up to 10 years, 15.4%, historical earnings growth, 18.9%. This is an Illinois-based home healthcare organization. So obviously, if you want to be a little contrarian, If you're thinking about everything that's going on in Washington and custom Medicare and Medicaid, you might expect that this stock would be sold off a little, which could push it into an slightly undervalued situation. But it's food for thought, certainly, and that ticker heat map is certainly someplace that you can go when you're searching for ideas and you want to know what the community is looking at right now using the stock selection guide. So those are great tools for finding ideas, which is one of the key questions that beginners and new members want to know. Where do I find good companies? Every time I look at the most popular meme stocks in the stock selection guide, it doesn't give me a favorable output. And that's true. Our model is very specific at looking at consistency of growth over time and profitability and solid margins and all of those good things, but we don't want to overpay. That's a relatively few number of stocks at any point in time in the marketplace. But once you have a stock, once you've analyzed it using the tools, then we have some additional sentiment tools that can help you to round out your research, bring in a second opinion, understand how the community is viewing a particular company. In specific, we have the member sentiment tool is part of SSG Plus, which aggregates the judgment and forecast for some different projections that members utilize when they're doing a stock study, such as projected sales and earnings growth rates, and the projected or expected high and low PE ratios, projected earnings, what's the range in the next 5 years, the percentage payout. It might be changing for a company that has capital and is increasing their dividend, and what the bottom line projected total return is for a company as it meets your selected growth rates and reaches your determined PE ratios. So the tool has means and medians, it has values with histograms, it has automatic outlier removal, and it will show you a table of all the studies of the last 90 days. So that's a lot, but let me show you what it looks like here. There's a sentiment tab at the top. Here we are at United Healthcare, wanted to understand a little bit more. What do members like about this right now that it's popping up, bubbling under on our most active list? So over here, I've clicked on total return. So from the current price, our members are looking at total return at a mean of 22% a year. The median is 22.5%. You see the histogram on the right there, giving you the various ranges of total return. You can see some details on the standard deviation, the number of outliers, studies removed, the total number of studies. So in this case, 219 after removing 92 outliers. So that gives us a real sense of a strong following for this particular company. At the bottom, there is a table that can be sorted, and you can look at each individual anonymous selection of what growth rates people are using, how optimistic or pessimistic are they. And so this has become part of that process. A lot of clubs and want to know what's the sentiment for stocks that we're following, what's the sentiment for this stock that we're considering, what does the community have to say about this particular company. And that is one of the benefits of being in an organization that supports individual investors. And then finally, there's another tool, the SSG Notes. When you conduct a stock study, you can add personal notes, which is very useful. Where did you find the idea? What's the additional information that you came up in your research that you wanted to remember? Because if you're, if you're like me, a week after you buy a stock, you've already forgotten half of what you learned about it. So the notes field can be very useful. But one of the advantages of having an online distributed tool is that you can make your notes viewable by other users by marking them as community notes. And you can see other members' community notes. And there's also staff notes that will show you if there are data adjustments, fiscal year changes, if there's a merger or something that may have impacted historical data. The staff can make individual company notes as well. So there's a notes tab here and you can see in this case, there are 7 notes. In this, we're showing here the community notes, my notes, and staff notes. They're all color coded. and you can read back in May, this first individual says that they can rate it no longer than a hold, explain some of their rationale behind it. Down below it, the second person says this looks to be a little expensive. And so once again, it's always good to have your opinions challenged. This is not a popularity contest. You want to stick to your discipline. And so sometimes having that additional external input can give you pause and make you consider that you're not just glossing over some of the details because of your drive to and desire to find the next big 4-bagger or 10-bagger in your stock research. So those are some of the tools that we have at Better Investing that we offer for our community members to give them a sense of the sentiment about particular companies and suggestions for stocks to study based on the research of all of our members. We're happy to welcome any questions now. Jenna, I'll turn it back over to you.
Excellent. Thank you so much. Let's take a look at some of the questions. I know a lot came in, so thank you so much for participating. We really appreciate it. Sending all your questions in. And then if we don't answer it here today, because we do have a short amount of time, please email members@AAII.com for any AAII questions. If they're specific to sentiment, you can email Wayne@AAII.com. And then if you would like anything to do with Better Investing or Doug's presentation, you can also, I put this in the chat earlier, you can email service@betterinvesting.org. But let me take a quick look. Okay, let's see. First question, I think this is directed to Wayne. So how do you suggest investors use sentiment data during very short downturns or volatility like we saw last April?
I mean, I think overall, the way that you'd really use sentiment is, again, I view it's more of a lens. It's not a crystal ball. And so if nothing else, it helps you recalibrate expectations. I think that's ultimately the biggest use of it, because as we've shown, as some of the slides that I showed, it's very good at identifying when the market is at a top, not so good as identifying when it's actually either going to roll over or when it's bottoming out. So I think that for individual investors, I think when you start seeing either asset allocation or sentiment hitting those extremes that historically have marked either market bottoms or market tops, that's when you really need to start paying close attention and probably start recalibrating expectations. If you're seeing sentiment hitting levels that historically has shown a market top, and your expectation is for the market to keep going up, you might need to temper those expectations and start potentially making some tactical moves to your portfolio. But I think ultimately that's the best way that you use sentiment. Is, again, it's not a precise tool, but history has shown that if you ignore it, you're doing so at your own peril.
That makes sense. And let's take a look. We had a couple questions for you, Doug, as far as, it's kind of a two-parter, but how should a beginner use the bubbling under or first cut list? And then also kind of to tag along with that, where can you find the bubbling under and first cut lists on the Better Investing website?
Those are member features, so you'll have to log in, and then at the menu at the top, there is an option for stock ideas, I believe it's called, and that's where you'll find most of those features. On the handout, there are links that will take you directly to those particular features if you are members. That'll help you to log in and find them there. As I mentioned, for beginners, the first cut stock reports are great tools for learning what the process is really all about. Yes, it's a paper form as initially conceived, the stock selection guide, and it has spaces that you fill in, right? Math that is done for you. But the real part of investing and investment decision making and research is, what is your assessment of a company's prospects? What do you believe it can realistically achieve? And when formulating that answer for yourself, you might incorporate analyst estimates. For instance, you might incorporate company guidance. You might incorporate buy side or sell side research that you are able to access. But this is another tool that can augment that toolbox and provide you with, again, some other input from more experienced, perhaps, members who are saying, yeah, this particular company, this is why I chose this growth rate. Here are my data points. And so it's very illuminating, I think, in that way. If you sit down and just walk through the tutorial on the website about using the stock selection guide, yeah, it'll explain it all to you, but until you actually sit down and find a company and go through the process yourself, then you're going to really learn how the tool works and how to make better decisions for your own portfolio.
Excellent, excellent. And speaking of tools, this is directed to Wayne. You talked about, and you showed the stock ideas and screens that we have. How often are those rebalanced, and then how often are they updated on our website?
Our stock screens are run daily with end of day data. The vast majority of our screens are based on fundamental data, which at most is probably being updated on a quarterly basis. So there's probably, if it's a purely quote unquote fundamental screen, even though there's the potential for those screen results to be changing on a daily basis, they're probably not seeing much change on more than a quarterly basis. Now, if it's more momentum oriented or price driven, that could be changing, high turnover rather quickly, depending on, especially on the direction of the market or the speed at which it's moving. But I mean, overarching, these screens are run nightly with that day's data, close of day data. And so there's the potential for these lists to be turning over on a daily basis. And like from our historical backtesting standpoint, we assume equal weighted shares as well. It's not one share; they're equally proportional. But we also assume that we're investing in all of them. So if a screen has one passing stock, then all of our eggs are in that basket. If there's 100 stocks, then it's equally invested in all 100. So that's our methodology.
Excellent. Thank you for answering that. And so we have a couple similar questions. So I wanted to, it's kind of, I think Doug and Wayne probably have some comments on, so we'll start with Wayne, and then Doug, you can also comment. But a lot of people are saying, market sentiment seems like market timing. Am I missing something? Isn't that a bad way to invest? So can we give some insight on that?
I mean, I wholeheartedly agree. Me personally and AAII as an organization, I think market timing is not the way to go. And so, yes, if you look at sentiment, you could consider it a market timing tool. Again, I think going back to the question that was asked initially and the answer that I got, I don't view this as a tool to time the market. I think it's a tool that helps you potentially modify your expectations for where the market is going. And I think, those are very important distinctions. Again, if, obviously past performance is no guarantee of future performance, but it's happened enough times that if you are seeing either asset allocation or sentiment hitting an extreme, it's definitely a time to start paying attention and potentially be recalibrating your expectations. So that's so if you are, if you say, okay, stock allocations has risen above 70% and you sell based on that, that is market timing. And I think more often than not, it's not going to be a successful trade. But alternatively, if you see stock allocations rising above 70%, it might be a time to make some strategic allocations of your portfolio. Maybe scale down your allocation to stocks, either move to bonds or build up your cash reserves, and then if there is a market correction, then you do have that dry powder to redeploy and to buy the dip.
I would add, I agree with Wayne. When we look at the history of investment clubs, which is our big one of our big membership cores, we going back 50, 60, 75 years, some of the clubs tell us they were most successful because during some extended bear markets, they kept meeting every month and they kept putting money into the market, and they kept finding that there were a lot of buy opportunities. And so those bear markets, those times when the market was very pessimistic, when investors were not buying, provided opportunities, and that allowed them then, when the market recovered, to see outsized returns. Certainly one of Better Investing's principles is to invest regularly, but I don't think that means that you have to invest every day, every week, every month, every quarter. What does investing regularly mean? I like to think of and we certainly don't counsel, I don't counsel clubs and investors to sit on cash, right? To build up your cash balance and wait for the opportunities, but to constantly be on the lookout for opportunities during every market cycle, no matter if the market is the market's high. The S&P 500 has reached new highs, all-time highs right now, but the S&P small cap 600 is down for the year. So that means maybe if we look mid-markets, mid caps, small, we might be able to find opportunities there. And I like to think of it as making micro adjustments. We're not, instead of investing every 2 or 3 months when we collect capital in our club and we have enough that justifies making a purchase, maybe we wait, or we look at other companies that have better opportunities than the large caps that the rest of the market is gravitating towards, or vice versa is negative towards. And I think there's a certain amount of education that you gain from the experience of investing through different market cycles, and learning that when, as Warren Buffett said, if we invest when everyone else is fearful, we're actually going to be smarter and come out ahead of the game. So if sentiment helps you to give you some sort of a foundational base that says the rest of the market is really negative right now, this bear market looks unavoidable, or we're in it, that this is a time for us to be really looking for opportunities in equities, then I think that's a big bonus, and that is what pushes AAII and Better Investing members a little bit in front of the rest of the herd, because of that ability to assimilate that the psychological moves of the market and react to them in a way that is not self-defeating, like so many of the other meme stock investors are doing out there.
Exactly. And before we kind of wrap up, I know we're getting a little long, so I want to be cognizant of everyone's time. I did, and then we're also going to share a couple special offers and things. I've been putting things in the chat, but I want to reiterate some of those before we sign off. I'd like to give Doug and Wayne a moment for some closing thoughts. Wayne, do you want to start us off?
Well, I would just say, Doug, fabulous presentation. I like this. I think this was a very complimentary presentation. My side was more of a macro level type presentation, but I really liked being able to see at the more individual stock level and seeing individual investor sentiment at that. So I thought that was I thought these were very good complementary pieces. History has shown that looking at sentiment, asset allocation is an excellent way to get a read on the overall markets. Either is it topping, is it bottoming? Not from a market timing standpoint, but again, that ability to recalibrate your expectations and make to steal from Doug, sort of make those micro adjustments accordingly. So I think that's overarching the most important aspect of analyzing asset allocation, investor sentiment. But also, like in anything in investing, there's no one single silver bullet. So you need to look at it from, I like to use the term a mosaic standpoint, is, you want to look at sentiment within the context of, either market fundamentals. I mean, if you're a technical investor, you might be looking at breadth indicators, momentum indicators, things like that. But the key is if this is not something you're acting on in isolation, it's one piece of a broader puzzle. And so I think that if there's one thing to walk away from tonight is, this is a way to get a read if the market might be at a market top or market bottom. It still might be months away. And once it rolls over, it still might take months or even years for that rollover or rebound to play out. But at the same point in time, it's an added tool in your toolbox to give you that slight leg up on others that aren't paying attention to this. So I think that's the best way to use it. But again, I want to also I'll pass over to Doug, but Doug, thank you for joining tonight, and I learned a lot from your presentation, so thank you very much.
Yeah, thank you, Wayne. I think my take on the sentiment tools. One of the common questions that you probably get, and that those of us who work for Better Investing in AAII and in the financial services industry, people want to know, why is the market behaving the way that it's behaving? And we can never fully answer that question, but the sentiment tools that you've demonstrated, I think, can tell you, well, we don't know exactly. The reason why people are behaving the way they are is reflected in the assessment of the member sentiment, right? It still doesn't tell you why each person who thinks the market is, why each person who's bullish and who's bearish, what their reasons are for it. But it gives you a sense of a lot of people are thinking along a particular line at one point or another. And that's that kind of insight that kind of overlays the decisions that we make. Whenever we invest in an individual stock, we're investing because of an assessment of what we think the popularity of that stock should be, because we're purchasing it when we think it's undervalued. And undervalued is simply another way of saying this stock is not as popular as other companies that are gaining more investor interest. And once you start thinking about PE ratios as a measure of popularity as opposed to a mathematical ratio, I think you gain insights into the analysis of individual stocks, and by transference then into the broader market. When you look at the PE ratios of the S&P 500 and you look at the trend over time, that's one of the things that I track is looking at the PE of the S&P over the course of decades, and is it rising? Is it going up? And what does that tell us? Well, that tells us that people are very, very bullish, obviously, that they're willing to pay multiples more than they were 10, 20 years ago, or during market downturns when they become pessimistic. So there's a lot of good ground to be mined with sentiment tools and with understanding the sentiment of the market and the sentiment of individual investors, I think, that can help anyone improve, even if it's those tiny adjustments, or answering that question, why is this stock going up, why is that stock going down? And it comes all back around to investors are humans, and humans do weird things. We can quantify them even if we don't understand them.
Well, thank you. That's a great answer. And I want to thank Doug and Wayne for their fantastic in-depth presentations. And then, like I said, I have a few things to kind of, go over before we wrap up. First off, thank you so much to everyone who participated in our question section, who joined tonight. We loved having you. And then, if you have any questions about AI's tools or services, like I said, feel free to email us at members@aai.com, or if they're specific to sentiment, you can email wayne@aai.com. And then you can also call us at 312-676-4307. And that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then if you, on the other side, if you have any questions for Better Investing or specifically on Doug's presentation, please direct your questions to service@betterinvesting.org, or you can call 877-275-6242. And then now for I just want to go over our two kind of exclusive attendee offers that we're offering tonight is you can save over $100 on our newest offering, AAII Sentiment Investing, which launched this July. And this includes access to our powerful new dashboard, weekly insights, and commentary from Wayne. Plus, you get full AAI membership benefits as well. And if you'd like to redeem this special attendee offer, you can visit AAII.com/betterinvesting. And then Better Investing is also extending a special promo on their side to their membership, which is now $99 for the first year, regularly priced at $145. And then if you want to access this deal, please visit betterinvesting.org/AAII, and you can enter the promo code AAII at checkout. And then lastly, this presentation was recorded and a replay will be available at AAII.com/webinars later this week. And then all webinar attendees will receive an email with the link, as well as all the other good resources that we included in the chat, and then also the PDF handouts from Doug and Wayne. And you should receive that email in the next several days. And with that, we wish all of you viewing good health, good fortune, and a great rest of your evening. Thank you so much and take care.
Thank you, Jenna.
Thank
Have a good
you.
night.
Bye-bye.